Ryan Isakainen. First Trust just launched its first actively managed ETF. It's an energy infrastructure fund. Tell me all about it.
Well, it's called the First Trust North American Energy Infrastructure Fund. The ticker symbol is EMLP. And this is a fund that invests in master limited partnerships, their affiliates. It invests in pipeline C corporations, Canadian infrastructure companies that used to be the old Canadian royalty trusts, and utility companies that have infrastructure assets.
Certainly a hot sector. What are some of the names that are in it?
Well, TransCanada is one of our top holdings, Kinder Morgan, Enbridge Partners, a number of those energy infrastructure companies that are not focused on production, and so they're not as cyclical, but more focused on transmission of electricity and transportation of fossil fuels. So you're collecting a steady stream of growing cash flows, most often are tied to inflation, and so that's why investors like this asset class.
So it's all about yield, yield, yield in a time when yields are very low elsewhere.
That's right. This is a non-correlating asset class that you're able to collect north of 4% in most cases.
And once again, people like the pipelines because it's not about the price of the commodity itself, it's about getting paid that so-called toll just for passing it through the pipeline.
That's right. And we don't see any time soon where you're going to see a huge decrease in energy consumption, especially with the production boom that's happening in places like North Dakota. You've got to transport all that fossil fuel. And so, the future looks pretty good for these companies.
And how actively managed is this ETF? How often are you trading in it?
Yeah, this fund will have a turnover that will be well less than 100%. Most of the turnover will be due to rebalancing positions, but it is actively managed by Energy Income Partners. We've partnered with them in the past to manage our closed-end funds. They've got 2 closed-end funds that they sub-advise for us. And so portfolio turnover will be minimal, especially because we're investing in high-quality companies, mature companies with consistent cash flows, and those things don't change quite very often.
MLPs are a very hot item right now as people look for yield because there is none elsewhere. That said, people have moved away from them in the past, avoided them because of the tax implications. Tell me, what are the tax implications of your fund?
So our fund is a 1099 fund, and we qualify for a regulated investment company. And that we do so by limiting our exposure to master limited partnerships to 25%. If funds exceed 25%, they're taxed as a C corporation, which means they have to pay corporate taxes as the fund entity. Because we're avoiding that, our fund doesn't pay corporate taxes, and that's a huge benefit to investors, especially because you're getting exposure in a fund, but you still get a 1099 instead of several K1s.
This market is
stock pickers market.
Stocks have rallied this year.
We're coming into a Monday where we're going to